Hey guys, it's Cam for Investors Underground. I'm so glad that you've landed on this video today, as it's the very first lesson that we're putting out of a long series of videos where we cover a beginner's guide to trading, and then an intermediate guide to trading, and then a more advanced guide to trading, each of these guides containing 8 videos apiece. And we're going to be releasing all of these videos for free for everyone to watch online at their own leisure and time, to try and bring all of you guys up to speed a little about the way that we trade the markets and the way that we make money doing so. We're going to be trying to put out one video every week on Wednesday, 24 videos in total. So you're going to be getting a lot of free content over the next 6 months. As some of you already know, I've been making trading videos on YouTube for the last handful of years. However, what I'm really committed to right now is delivering the highest value content that you can get for free anywhere online on the subject of day trading. The way I've approached developing these guides is I know there are going to be tens of thousands of people watching this. So not only do I want to save all of you guys the time, energy, and exhaustion of trying to get up to speed in the markets by yourself, by providing all this educational content, I also want to save you time while you're watching it. So during this series, you're not going to hear a single cough, a splutter, no ums or ahs, no awkward pauses, no flipping through awkward slide decks or PowerPoint presentations. It's going to be the highest value, concise content that I can put together. Because I know if 100,000 people watch this video series, and I can save each of those people not only 6 months in learning and hardship in the markets, but also save you 10 minutes every video by cutting out all the bullshit, then I know I can cumulatively save years of human time by spending a little more of my time making sure that this is the right information. So there's no need to skip through any parts of this. Everything that's been put into this video series is there for a reason, and you need to know it. So right now might be a great time to hit the subscribe button so that every week when we do put out a new video, you don't miss out on it. That way you'll get some kind of little notification from YouTube when we put things out. So let's get into it. During the next 8 lessons, we're going to be going over what day trading is, why you should be interested in it, how do you get started, what candlesticks are, how to read level 2, time and sales, and the importance of volume. We're going to do an introduction to bullish patterns and an introduction to bearish patterns. We're going to go over the significance of multiple time frames and also chat about the platforms we use, the brokers that we prefer, our trading computer setups, and also talk a little bit about the pattern day trading rule. And we're also going to go into executing precise entries and exits, and how to know when you're wrong and also manage your risk. In the intermediate series, we're going to follow up with, setting goals and graduating from newbiehood, survival and account preservation. So we're going to go over transitioning from paper account to live money, intermediate bullish patterns, intermediate bearish patterns, early successes, skill levels, reality checks. I'm going to talk about what a squeeze is and how to avoid it when you're short and how to make money from it when you're long. We're also going to be talking about the short sale restriction or the SSR and how it affects the way that stocks trade. And I'm going to wrap up that intermediate series with the importance of really knowing how and when to take profits. Then in the advanced series, we're going to be talking about resetting goals and scaling. We're going to be talking all about psychology in trading. Nate's going to be talking about understanding the broader markets and how it affects day traders. We're going to be talking about more advanced bullish and bearish patterns. And we're also going to be chatting to a few of the other guys in the Investors Underground community about their take on trading and how they trade a little differently to the way that we do, but are still very successful. I guess the whole concept of these 24 videos in, 3 trading series, 8 videos apiece, is bringing the collective best minds in our trading community together and letting you learn from their experience in a very short amount of time. I don't profess to be the best trader in the world, but what I am really good at is bringing like-minded people together and sharing their wealth of knowledge with people who want to learn, which I hope is you guys. So let's get into the content of lesson 1. So as you can see, we've got quite a lot of things to get through in today's lesson, but we're going to start things right from the beginning and talk about, what is trading and what is day trading. So trading in this context is the act of buying and selling or shorting and covering some kind of financial instrument or financial product. The intention of this action is to make money from it. So for example, a trader in Forex might be thinking that a certain currency might be going down and a different currency might be going up. So to attempt to make money from their thesis, they'll place a trade where if their idea pans out, they'll book a profit. Day trading specifically talks about the duration of the trade. So a day trader is more of a short-term trader that generally doesn't hold stocks overnight. So they'll be entering and exiting trades on an intraday basis. Now you can be a day trader in Forex, you can be a day trader in futures, you can be a day trader in options, but Investors Underground, we're equities or stocks day traders. So I guess it makes sense that before we go into why we choose to trade stocks over any other kind of financial products, we should go into what trading stocks is or what it means to trade stocks. So essentially, when we're taking a position or a trade, we're actually buying a very, very small part of a company. And as technical day traders, we're not looking at whether the company has great earnings or whether they've got a good product mix or they've got great drugs in their pipeline, if it's a pharmaceutical company, or great technologies. We're really just looking at pattern recognition. So basically, the prices of these companies or the prices of these stocks go up and down based on supply and demand. And as they move up and down, it presents opportunities, patterns that we may have seen before. And it's our job as day traders to identify these patterns before they manifest and seize the opportunities and make a profit from them. And with experience and knowledge, we can get better at identifying these patterns. And even though we're not going to be right all the time, we're going to have consistency, which allows us to take a profit on a regular basis. The day part of day trading refers to the time frame in which we're taking these positions. So basically, these positions are entered and exited on an intraday basis. So we don't hold these stocks overnight or swing them through earnings. For the majority of the time, we're cash overnight, and we come back to the market the next day fresh, looking to do the same thing. So now we've covered what trading is, we're going to now look into why we've decided to trade stocks versus all the other choices out there. And I think there are really three main reasons why we trade stocks. The first is you've got a lot of choice. There are over 7,000 listed companies on major exchanges that you can decide to trade, and you can use a bunch of filters to choose the ones that have the best parameters to be trading. Now, they're going to be different every week or every month or even every day, but you can look for the most actively traded, you can look for the highest volatility, you can look for a bunch of different things. The second and third reasons are really the volatility and the liquidity. So volatility is just how much it moves around, basically. So every day you've got stocks that are running from, $1 to $3 or $4. You've got stocks that are coming from $10 down to $5. And all of these big moves create huge opportunities. And liquidity, if you're trading the right kinds of stocks, you can get in and out with size without impacting the market at all. So we don't believe that any other kinds of trading vessels can really give us all of these kind of opportunities. For example, in the Forex market, you might get something that moves, from $1.34 to $1.35, and that would be considered a decent move. However, in stocks, you got something that goes from, $1 to $6. You just get much more choice and opportunities in this area. So I guess I mentioned it a little earlier, but how do we make money from this? And the answer is by placing trades. We look to enter and exit these stocks based on patterns that we've seen before. So if we see a stock starting to do a particular thing and we think back to ourselves, hey, I've seen that happen, 20 or 30 times before. And every time it did that, it had an 80% chance of moving in this certain direction. That's what we might consider to be a high probability trade. And once we enter the stock, the price is going to move. If it moves in the direction that we wanted, then we're going to look to book profits. If it doesn't, then we're going to look to stop out and we'll book a loss in the trade. Whether we make money or lose money, we're going to learn from that experience, make some mental notes, maybe adjust the strategy very slightly, and then we rinse and repeat. It sounds simple, right? Not exactly. Pattern recognition can be difficult at times, and trading can be a very emotional game. However, with the right parameters, watching the right charts, and with the right tolerance to risk, that's how we make money in this game. Which I guess brings me to my next point, which is trading the right thing for you? And the big subpoint of this is independence. Trading is pure independence, and for some people that's great, but for others it's not. And independence is normally associated with something that's very liberating. However, it can also be very demanding at the same time. And what I mean by that is there's nobody ever there to tell you what to do, or to make sure that you rock up to work, or to police your trades, or make sure that you're sticking to your rules. You really need to be self-driven and self-motivated to have any chance of making it in this game. Independence also means that nobody else writes your check, so you have to extract money from the market month in, month out, and decide how much you're going to pay yourself from it. However, the upside of pure independence and trading is you've got unlimited earning potential. So if you do end up developing a skill in trading and you do see success, then you can scale up what you're doing and make the kind of money that you'd never be able to dream of making if you're working a 9 to 5 in an office pushing paper around. It really gives you the ability to be your own boss. You can decide which days you want to work. You can decide from where you want to work, whether you want to make a home office in your house, whether you want to work while you're on the road. It really does give you that freedom. So I don't want to risk sounding like I'm getting on a bit of a rant here, but in a society where the corporate world places more and more demands on people's time and seems to be continuously encroaching on people's freedoms to do what they want, this independence factor in trading was one of the big selling points that really made me pursue it while I was starting out. And sure, while I took a quote unquote temporary pay cut when I started because I was making a full-time wage when I was working in an office gig, and I went to essentially making nothing when I started out trading, and I was learning this skill, I was building something for the happiness of my future and financial independence. And I've got friends who work in offices right now who put in a 7 a.m. to a 7 p.m. every day, and they've got to time their toilet breaks to make sure they don't exceed in a certain amount. And it's really hard to feel like you're your own person or your own man or woman when you don't have the autonomy to be able to do the things that you want to do on your time. So I guess in the next little bit, I'm going to go over who we are and why you should care about listening to us about trading. Then I'll touch on how we got started in it ourselves. But basically during this series, you're going to hear the most from myself and Nate. So Nate's been trading the markets for over a decade, and he's the founder of the Investors Underground community and also of the charity Traders for a Cause. He trades full-time from his home in New Hampshire, and he's a bit of a tradeaholic. He is very active in his trades, and it's hard to pull him away from the screens a lot of the time. Which brings us on to who I am. So I've been trading full-time for 5 years, and during that whole time, I've been a member of Investors Underground. I learned how to trade through the Investors Underground community, came up through the ranks pretty quickly, and a couple of years in, I became a moderator at Investors Underground, and I've been moderating the chat room and creating content for the subscribers and for, the YouTube channel and that kind of stuff alike for the last 3 years. But really, I'm a huge trading education advocate. So I understand how hard it is to get up to speed and learn something new like trading. And I think that there's a huge advantage for people who learn from the veterans in this game. And it's a bit of a unique set of circumstances that, multi-million-dollar traders are happy to share their secrets to success to help empower the trading community. And that's really what we built at Investors Underground. So I'm very proud of that. So now you know who we are. I guess the next question that we get regularly is, how did we get started in trading? So Nate got started kind of early in life. He was inspired by his uncle, who was a businessman, not necessarily a trader, but he had investments in stocks. So Nate always associated owning stocks with being successful. was very inexperienced in trading, but ambitious at the same time. He wanted to make something for himself that had nothing to do with working for someone else or the 9-to-5 grind. But you got to start somewhere. So he saved up his money from a part-time job and learned how to trade in the OTC and penny stock markets. Since then, the OTC and penny stock market has kind of died out, and people who talk about trading penny stocks are now often actually misnaming them because they're actually talking about momentum stocks, and the stocks that they're trading are usually between $1 and $10 and have nothing to do with pennies. So as Nate was starting out, he was a great trader quite naturally and learnt from some of the best traders in the world. However, his great trading was disguised by big and uncontrollable losses. So starting out, that was something that he really needed to try and keep in check. So I guess the way that I got started is a little different to the way that Nate did. I was an internet content consumer, and I've got a little LOL here because basically that's just a nice way of saying I used to waste a lot of time on YouTube. But I guess luckily I came across some trading videos, and that kind of sparked my interest in the subject matter. And I'd watch hours and hours of different people talk about different things in the stock market. But I guess then I started to question, was the information that I was watching actually valuable at all? Or was it just some guy in his parents' basement talking about Fibonacci retracements, or some guy who never really placed a trade in his life talk about moving average crosses? And I think given that you guys are watching a free tutorial on trading on YouTube, that you guys are probably in the same boat as I was. So I started to become much more selective about the trading lessons which I spent my time on. And then I started to try a bunch of different things. I subscribed to a Forex service, I subscribed to a penny stock trading service, and I also subscribed to Investors Underground, all roughly around the same time. And there was something about Investors Underground that really clicked with my personality. The sharingness of the community, the way that everyone's there to help each other out, and the experienced traders sharing their wealth of knowledge to the less experienced traders, and I started to see myself improve a lot. I was very intrigued by the psychology behind trading, and momentum trading really highlighted, the pain and fear, or the greed, or hubris, or all of these kind of human personality traits. They were really exemplified in momentum trading. So given that momentum trading is the style of trading that Investors Underground focuses on, I naturally kept my subscription there and ended my subscription in Forex and penny stocks. So you've probably been hearing me use the term MOMO, or momentum trading, a bunch. So what exactly is that? Well, momentum trading focuses on stocks that have increased volume or range when compared to prior trading action. So I'll give you an example. A stock that's maybe been trading 200,000 shares a day at a price of $3 for the last 6 months. Suddenly one morning there's some kind of catalyst or piece of news or interest, or something's changed in the stock, and suddenly it's trading 1 million shares in the first 10 minutes of the day. And instead of trading, at around $3 to $3.10 to $2.90, it's suddenly trading $3 to $4 to $4.50 to $5. And what this does is it attracts a lot of eyes to this stock. A lot of people are going to be watching it and looking for opportunities to enter based on their own rules and set of circumstances. And because there are a lot of eyes, there are going to be a lot of opinions. Whether people think that the stock is junk and it doesn't deserve to be at $5 and it should be back down at $3. Whether people think it looks like it's going higher because it had a very strong move in the morning and it was holding all those gains. Different traders have different opinions about the ways to make money in the markets, and they trade those opinions accordingly. But with all these differing opinions, there are going to be groups of people who are right and groups of people who are wrong. And I mentioned earlier that trading can be a very emotional thing. So what we look to do as momentum traders is take advantage of other people's irrational, emotional button clicking. So if a stock goes from $1 to $3 and someone's really frustrated that they missed the move and they buy it at $3.10 or $3.20, they might be chasing into that stock and the stock might go down from there. Or if a stock's trading at $10 and it goes to 9 and 8 and 7 and it flushes out to 5, and people are kind of grabbing the oh shit handle and selling off their shares, we might be looking to scoop them up at $5 for a bounce to 6, for example. So these different emotional players create opportunities for us as experienced day traders to capitalize on their errors and make profit for ourselves. So I sometimes get people who aren't so familiar with the stock market ask me, well, Cam, what do you do when all the stocks are going down? And the truth of the matter is that you can make money regardless of which way the market's going or regardless which way the stocks are going. You can play them both ways. So you can long a stock and the intention is for the stock to go higher and you sell it at a profit. Or you can short sell a stock and the intention is for the stock to go lower and buy it back to cover and you make a profit that way. I'm going to be explaining short selling in much more detail in a later video, but all you need to know is you can play a stock on the way up, you can play a stock on the way down and make money from it either way. So we try and bring very little bias to the market. We don't entirely care why the stock is moving up or down. Sometimes it's useful to know what the catalyst is, but sometimes the catalyst can give you a bias which isn't helpful for trying to trade a chart. So if we don't care about why, then what do we care about? Well, we care about recognizing patterns we've seen before. We want to look for chart setups that have proven in the past that if we've seen them set up in this certain way, then they went on to do a specific thing. And we're placing a trade hoping that that specific thing will unfold as we have our position on. So in that case, isn't trading just the same as gambling? And I get this question a lot from people who are either friends or relatives, and they've seen what I do, but don't quite understand it. So I try and tell them an analogy about, predicting the weather. So some of you who have listened to my webinars with Nate or some of the other videos on the YouTube channel may have heard this before, but I compare momentum trading a lot to predicting the weather. So I've been alive for 29 years, and during those years, I've seen it rain a bunch of times. And now I believe I've got some kind of intuition as to some of the basic signals that it's about to rain and some of the more subtle signals that it is, as I would expect all of you guys to have as well. So let's use a real life kind of example. Let's say you're down at the beach and it's a really sunny day, but you start to see the clouds come over a little, and across the horizon, you might see a tiny flash of lightning. There's a different smell in the air and the air starts to become moist. And you think back to all the other times you've seen it rain in your life and you think, I think there's a pretty high probability that it's going to rain soon. So what you might do is leave the beach a little early, jump in your car and hit the streets, because as soon as those first raindrops hit, everyone else is going to be running to their cars and then be stuck in a traffic jam for an hour. And I tell this analogy because I think there are a lot of similarities between that and trading. You've got to be one step ahead of the herd. You've got to formulate a strategy based on patterns that you've seen before. And we're going to talk a lot about the patterns that we love the most in the Investors Underground community and the ones that we think have the highest probability setups. And then also use your intuition to get a good understanding of where the herd's at and what they're about to do, and be there acting before they make their move. And sometimes we get stuck in the herd and, caught in the traffic jam for an hour instead of being home in 15 minutes. And that can be frustrating. Sometimes it's a false alarm and the clouds pass over and a raindrop never hits. But as long as we're right more times than we're wrong, then we can make a consistent living doing this. So this next point is in here to try and balance out all the marketing crap that you're going to see about trading on the internet from brokers or companies or services that want to sell you on the dream of trading. Trading is not easy. I probably personally know more full-time traders than most other people in the trading community. And all of the guys that I know who are super successful, who make a ton of money doing it, don't do it from private jets, don't do it on sandy beaches or poolside with a bunch of babes hanging around. They do it the same way that we all do it, which is sitting in front of a bunch of screens, mostly sweating stocks all day. And I say all this because I think a lot of people are enticed into the trading world because they believe it'll be some kind of glamorous pathway to become a multimillionaire. And sure, the people who are good at trading are able to scale it and make great money, but this is not a glamorous profession. And a lot of the times it's either ecstasy or agony. If you're on a streak where you just can't put a winning trade together, or the stock market's just grinding you out and beating you up in general, it will truly test the fortitude of your strength and stamina. And this isn't what is portrayed online on trading Instagrams or some trading blogs, or when you cruise around YouTube and check out all these people going on holidays all the time and first class travel and all that kind of stuff. That isn't a true representation of what trading's about. And let me share with you why it's not easy. Trading is a very competitive marketplace. And the reason for that, and this is a bit of a economics 1001 lesson, is that it has very low barriers to entry. And what I mean by that is, for better or for worse, someone can go and open up a $10,000 trading account, have it approved within a couple of days, and be clicking buttons the next morning. And they probably shouldn't be doing that, but they can go and do that if they like. So as a business, it's not like opening a restaurant where you need a location, you need head chef, you need ingredients, you need a menu, you need waiters, you need all of these things. And a restaurant isn't even a specifically high barrier to entry kind of business. I'm just giving you a comparison. So when a business has very low barriers to entry, then it becomes a very competitive place to try and make money. So competitive, in fact, that there's a statistic that floats around that says 90% of traders who try and make it by themselves without any kind of support fail in this game. So you might ask, well, what are the 10% doing differently? And that's not entirely what we focus on. At Investors Underground, we focus on what is the 1% doing? What are the guys who are at the top of their game doing? And how can we learn from that to bring people out of the 90% into the 10%? So we use this methodology or ethos whenever we're creating any kind of educational content or any kind of lessons or material, so that newer traders can kind of dip into a brains trust and develop a proper foundation of understanding of the way that the most successful people approach the markets on a day-to-day basis. And these are really the pillar stones of the Investors Underground community. You know, we've got hundreds of members who are all watching stocks that they picked for a variety of reasons, and all bring different experience and different kind of contexts and different trading styles to the community. And we all share that knowledge amongst each other for the greater betterment of the community. So you're really getting thousands or tens of thousands of years of trading experience collectively between all the members that you're able to work on your weaknesses and build your strengths with. So who exactly are these 1%? How do you get in contact with them? And what kind of personality traits do they kind of share or all seem to have? Well, the 1% are what I consider to be the best of the best. These are people who have traded through all kinds of market conditions and proven that they're able to adapt and continue to make money regardless of the circumstance. These are the people we choose to be the moderators in Investors Underground. But there are also a lot of people who don't want the responsibility of moderating, who are still or do still fall into the 1%. Commonality between them is they all seem to have very small egos. They're not flashy people. They don't like to talk about money a lot. And a general consensus around them all is that they like to keep their private lives quite private and they live quite modestly. Another commonality between them is that consistency, as I was talking about earlier. They can come to the markets every day and be confident in themselves to know that they're going to make all the right decisions, even if it isn't a green trading day. Another commonality between them is they've been able to scale what they're doing because they do have that confidence and consistency, so that they can turn, the $100 or $200 or $300 a day into $1,000, $3,000, $10,000, $30,000 a day. We've got a handful of people in the Investors Underground community that trade for 5 and 6 figures every day. And famously, Modern Rock's $1 million day pretty much went down in the history book of Twitter traders as a real amazing feat. The last thing about the 1% is, for the most part, they're very generous with their time. I know I've personally reached out to a number of these people before I was a moderator or anyone who was known in Investors Underground, and they took the time to answer my questions, to show an interest in what I was doing, and give me their advice on what they thought I was doing right or wrong, so that I could learn from it and become a better trader myself. So in this next section, we're going to talk about risk versus reward. And you may have heard this a lot in trading theory, as it's quite an important part of every strategy. It's really important that you extract value from chart setups. And what I mean by this is look for setups where you're getting paid out in some kind of positively geared ratio on your risk. So if you're risking 100, you might be making 200 or 300 if you're right, but losing your 100 if you're wrong. When you combine that with trading high probability setups, you know what I was talking about before, where you know that there might be a 70 or an 80% likelihood that the chart is going to do what you want it to do given the circumstances or the set of parameters that it's been displaying. Not only will you get paid out 200 to 300 on your 100 risk, but there's an 80% chance that you're going to be right as well. That's a very ideal set of circumstances. So for newer traders starting out, they should really have a defined risk when they go into every trade. And what that means is they need to set a level in their head or set some kind of hard stop where if they're wrong in the trade, they'll know where to get out and how much it's going to cost them. So no catching falling knives, no shorting parabolics, none of that kind of stuff for newer traders. You really want that defined risk with that positively geared reward. As I mentioned earlier, your winners are going to be bigger than your losers if you've got that positively geared reward to risk ratio. And I think something that's very important on this screen here is you can afford to be very selective. You know, you've got thousands of different stocks to choose from. They're all moving, they're all doing something. You don't need to force trades or feel like you need to force trades. The market will be there in an hour, the market will be there tomorrow, the market will be there in a week. You don't need to push trades that don't have that positively geared reward to risk ratio. You don't need to push trades that don't look like they're setting up to be a high probability pattern. So you've been hearing me talk a lot about high probability setups, and in this video we're not going to be able to go into them in great detail. However, I do want to go over a couple of higher probability setups for newer traders. So we're going to be exploring the ABCD pattern for a long, and we're going to look at lower highs and a fader for a short. So let's start with the ABCD long. So basically the ABC trade is built around the ways that stocks move upward. And a lot of people say, hey, buy the dip or buy the breakout, but without the right approach to risk and making sure you get paid out the right reward for it, that advice is only half true. So for example, let's call this blue line a large upward move. You don't want to chase this and buy it long here because you don't know where the pullback's going to be and you don't really have a defined risk to base the trade off. So what we found in our experience is there's a better way of getting long on a stock that's trending higher without risking as much and also getting more of a confirmation that the stock actually does want to move higher rather than chasing something that's already running upward. So right now, as I said, you're looking at that large morning move, but what we're going to be looking for is some kind of pullback that's going to get our attention. We're going to start monitoring this and essentially looking for a scenario where there is a higher low that might suggest to us that this stock isn't going to go and give back all of its push, and it might spend some time at a slightly higher price point and set up for the next piece of this trade. So we're not really ready to buy this yet because we don't know where the bottom of this pullback is going to be. We still want to find that defined risk that we know we're going to be getting paid out on. So now let's say the chart has made a higher low, but at the same time, it's also sort of made a lower high. So we're still not entirely ready to buy this. You might consider starting in with a partial position if the daily chart is really set up. But if, let's say, this initial move upward was a very large move, there could be shorts looking at this, saying that this is actually a lower high and it's going to retrace some of those gains. And that can be one of the reasons that the ABCD pattern gets propelled if it does make an up move. I'll discuss a little bit more about that in a moment, but from a long perspective, this chart has now made a higher low. It's already on people's radars because it's made a nice big move. Predominantly in the morning, those kind of big moves happen. And right now, what you're looking at is the textbook ABC part of the ABCD pattern. And you've got A, which is the push. You've got B, which is the subsequent pullback. The chart's showing that it's making higher lows. So as it perks off this level here,
I'd consider that C, and you're looking to buy anywhere within this box or even slightly above it with your risk on B. And for the more novice traders, you might like to set a hard stop under B. Nate doesn't use hard stops because he likes to leave a little bit of wiggle room. If someone goes and hits a bid and it takes a quick spike to the downside and comes right back up, he doesn't like to get stopped out in those scenarios. But basically what you're looking for is to risk down on B. If you're getting paid out the proper reward on the risk to B and the chart starts to top out at that A area, you can actually consider locking half as long as the reward was relevant to the risk that you put. However, the real idea of the ABCD trade is to have it break that previous high of A. And often when it does, it's pushing onto the high of the day list. It's going to get on people's radars and they'll cause the move from that previous high of the day up towards that D level. So a lot of the time you can be getting paid out between 2 to 1 on your risk up to, 4 or 5 to 1, which is a really ideal circumstance. The fader setup is probably the second best kind of trade for a beginner or intermediate trader after the ABCD long, because it tends to favor that kind of set risk versus reward. You're not catching a falling knife or shorting into a parabolic without that set risk. You're entering trades, you know how much you're going to be risking on it if you're wrong, and you've got a good idea of where your potential target points are. So basically the way these faders manifest is that an overextended chart starts to put in some lower highs, and on a lot of these there's some kind of line in the sand where once it dips under that certain level, you get a feeling that it might come in a little bit and retrace some of its gains. Now in terms of what these gains are, the gains can be an overextended daily chart or an overextended intraday chart. You've got to look at the full picture to see, hey, why am I looking for this kind of setup as a fader? But you can see that as it comes down and tests one of the lines in the sand, that's a great spot to start in short. Your risk can be above the previous highs or up into the high of the day if you want to trade a slightly smaller position and give it a little more wiggle room. And if the stock breaks that kind of line in the sand, it might have one more support level to get through, but it's going to be very weighty as it heads down there, because essentially this stock has changed trend, and you can either short it on pops as long as that previous line in the sand holds as top, risking the previous high, or you could add as it looks to break that support. And when it snaps fast, so you sort of need to be ready to cover at least a portion of your position, but often you can get paid out 2, 3, 4 times your risk when that emotional panic sets in, washes out hard, scared longs are hitting the bid, shorts who are chasing are trying to short it down, and those are the areas that you're looking to cover because you had the foresight to know that this chart was setting up. This is one of my personal favorite setups because I find it tough to believe in stocks. So I'm not as good on the long side as I am on the short side, but I like to have that fixed risk as I'm going into a trade. So for me, this is the best of both worlds because I get to short the stocks and I get the fixed risk. And I love seeing it wash out and cover into the panics.
So that was a bit of an introduction into the kind of teaching methodology and content that we put together for our DVD courses and in our webinars and video lessons in the Investors Underground community. If you're not already subscribed to the YouTube channel, it's free. And depending on where you're watching the video, you can click this button here or hover over this little icon here and there'll be a subscribe tab. And I just want to go out and say that I appreciate every one of you guys. You've given us a great platform to be able to share content and our trading ideas, and it really pumps me up when I see more and more subscribers every day and people liking the videos and commenting and really engaging. So to all our subscribers and everyone who likes the vids, thanks a lot. I really appreciate it. To anyone who isn't subscribed, you can do so by clicking one of those buttons. And basically what it means is whenever we put out a video, you'll get like a little notification on YouTube to say that there's some new content on our channel. So if you like what you see, please give it a thumbs up. And if you're not already subscribed, it doesn't cost anything. all you need to do is click a button, because it helps let me know that you guys are enjoying what I'm putting out and encourages me to put out more of it at the same time. So the last thing I'm going to cover in this lesson is size management. And I get this question asked regularly from newer traders who are maybe a little confused because of previous investment style advice that they've received in the past. So they might ask me something like, how many shares should I buy? Or what percentage of my account should I put into each trade? Or do I need to diversify when I'm trading? And really, it is actually none of these. The size that you choose to trade is all based on risk. So you work out how much you want to risk per trade. Let's say it's $100. You look at the chart and you work out how far away will this go against me before I know I'm wrong and I take it off. And let's say that distance is 20 cents. It's 20 cents under the nearest support level. Well, if you want to risk $100 and your risk is 20 cents, then you're going to do some basic math and trade 500 shares of that stock. Now, if it's a $1 stock with a 20-cent risk, then it's going to be a $500 position. If it's a $10 stock with a 20-cent risk, it's going to be a $5,000 position. So it's not about the size of the position relative to the size of your account. It's all about the risk at hand. And as you become more confident in your trading, you can increase the risk relative to the size of your account. So when you're starting out, let's say you've got a $30,000 account, I wouldn't suggest risking more than $50 or $100 a trade, something that you've got a little skin in the game, but if you lose 2 or 3 trades in a row, you're not going to beat yourself up over it. As you get more confident, you might decide to risk $2 or $3 or $500 a trade, but you don't need to go and stick an extra $50,000 or $60,000 in your account just to make sure it's the same percentage. You can risk a little more when you're comfortable. It has nothing really to do with the size of your account. So in the next video in the series, Nate's going to be exploring chart analysis. He's going to talk about candlesticks and why he likes to use them and the ways that he interprets them. He's going to be talking a bit about volume and why it's important and why it matters. He's going to be going into some basic concepts of level 2 and how to read it. He's going to be looking at the importance of time and sales and also discuss some thoughts around selling pressure and buying pressure. If you click this button here, you're going to be able to go straight through to the next video. And if you have any questions at all about what you've watched in the video, or you just want to drop me a note about what you've been doing trading so far, you can contact me directly. My email is cam@investorsunderground.com. These come straight through to my inbox and I reply to each one of them personally. So drop me a note if you want to get in contact. This has been Cam for Investors Underground. Good luck with your trading.